Everyone, this is Rob Roy, and welcome to the Elliott Wave Options U.S. Market Update. Well, if you've watched these updates before, notice the background's a little bit different. Came up to a mountain cabin for a couple of days and got snowed in. Well, luckily the internet still works, so here I am. What happened to the markets this week? Did the Federal Reserve kill the bull market? We'll talk about that. The non-farm payrolls number came in. It was a disappointment, adding 199,000 non-farm payroll jobs, but that was less than half that was expected. And then interest rates. In the last recording, we talked about how they had broken out of that symmetrical triangle. Well, they rocketed higher this week. So with all that said, let's take a look at the charts. At the time of this recording, it is a little after 11 o'clock on Friday evening, so currently the futures market is closed. Taking a look at the chart of the market, you can see the big drop that occurred on Wednesday. Well, what happened Wednesday? Wednesday was when they read the new Fed meeting minutes, the meeting minutes from the December meeting. And what shocked the market or surprised the market, because the market was really going dead sideways until the minutes were released. And there was a lot of conversation, a lot more than it was expected, on the Federal Reserve not only tapering, which they think they're going to end the tapering program in March, is what's expected now, and then beginning to raise rates. But additionally, and this is the big one, they started talking about reducing their balance sheet. So that means that not only are they going to stop the injection of liquidity, not only are they going to start raising rates, but they're going to start withdrawing liquidity as well. And that was something the market wasn't really prepared for. Had a conversation about this in our meeting with TradeFinder this week, where we talked about, and by the way, if you haven't signed up for TradeFinder, please do so. You can sign up with the link here in the video or go to our website, ewotrader.com. It's free. We talk the markets every Tuesday night. We look for trading ideas, etc. But what we were talking about is the Federal Reserve and this plan for starting to withdraw liquidity, but that was going to be something that was pushed out into 2023. So that was the big deal. That's what moved the markets to the downside. Markets weren't prepared for that. And then you can see here on the low on Friday today, we tapped the 50-day moving average. So is that it? Was this just an excuse to sell? We retraced some of this low volume early Santa Claus rally that we talked about in the last recording with this vertical move to the upside. Is that all that was going on? Or is there something more afoot here? Well, let's take a look at the volume, and you can see that above average volume on the moves to the downside. And I think the most important thing when looking at volume is the fact that it wasn't phenomenal volume that occurred on Wednesday. In other words, it wasn't a massive volume spike where you think that, okay, everybody that sold or wanted to sell sold and they're done. It was just above average volume. In that kind of scenario, it leads the one to believe that there could be some more selling to come from that. So taking a look at this low of the 50-day moving average, we could bounce from here, but if not, the next move would be likely to come down and test support down here around 450. So breaking that 470 level was key, and now we've had follow through breaking below that. So the next level of major support is there at the 450 level. The beginning of the week will tell us a lot if the market tries to bounce. We're not really that oversold, surprisingly not either, from the 10-day moving average. So things that would make you think the market can continue to move to the downside is we didn't have massive volume on the selling, and we're really not that far below the 10-day moving average. So it would seem that that target of 450 is really achievable. In the intro, we talked about how interest rates not only broke out of the triangle, as we had highlighted in the last recording, but look how vertically they moved right up into this wave 5 forecasted area. In fact, we've labeled the wave 5 now. Pretty vertical move on interest rates. The market doesn't like that either. The market can handle increased rates. I've talked about this in past recordings that I felt like the market would be okay if rates moved to the upside, as long as one, they didn't go vertically, and two, I think just that round number of a 2% on the 10-year would be something the market wouldn't be too good with. So we're not there yet, but we have the vertical part of the move, although we are at this point in time a little bit overbought on the 10 years. So perhaps we start the week with maybe a little calming in interest rates. Maybe that gives the market a chance to move back to the upside a little bit, maybe a little bounce off of that 50-day moving average. I've said numerous times that as the interest rates go, so will the market go. And that really seems to be in lockstep at this point in time. Looking at the dollar, you would think the dollar would be doing okay in this environment, and it has been. To mention the jobs report in the intro as well. The jobs report, as far as the non-farm payrolls, was a bit disappointing, but wage inflation is skyrocketing in some sectors, leisure, hospitality, etc. Wage inflation is over 14%. In other words, those wages have gone up significantly, and the administration is obviously trying to say, yeah, people are making more money. That's not good for the people that are employing the people that are making so much more money. I mean, it's great when people make more money, but not when you have inflationary pressures causing it, as they are with wage inflation. Just another sign of all the inflationary issues that are occurring across the spectrum within the markets. But so far, the dollar has hung in there pretty well, consolidating this big move to the upside. You can see that this is kind of modus operandi for the dollar. We had the same thing here where we had this big move up in September, consolidated it, another big move up, and we're consolidating that. Does the dollar go higher from here? I think it's important that the dollar stays firm. You can see that we've tested the 50-day moving average a couple times over the past week. And the reason that I say that is in this environment, with interest rates starting to go up, if we lose the dollar, that's a really negative sign from an economic standpoint. So if the dollar stays firm and we don't get crazy inflation, maybe if we touch that 2%, it shocks the market for a day or two and then we back off. The markets can handle that. And see how that plays out. But if the dollar starts to tank to the downside, even if it just goes down to create this wave four, you could argue that that's still bullish in an upward impulse pattern. But a break that far down where this forecast wave four is, with everything that's going on right now, I think that would foretell not just weakness in the U.S. economy, but global weakness. So I, for one, am rooting for the dollar to stay firm. Looking at gold, surprisingly, gold backed off a bit here. I thought that we would go up and test this area around 174 with gold, and we still may. If we take a look at the 10-day moving average, though, you can see that we are below it, and we're below the 50-day moving average. So gold needs to recover that, move back to the upside if we're going to obviously go back up and test that area. So far, you can say that, well, we do have still a bit of an uptrend in place. We broke below it here, so if we don't jump back above it at the beginning of the week, then that would be out. But it would surprise me if we didn't see some sort of a bid come back into gold with where we are right now. Oil is acting exactly as you would think it would should be acting, moving to the upside, which is what kind of would think gold would be doing too. Now we get to the point we're in January. Is OPEC going to go along with their production increase? They talked about increasing 400,000 barrels, and that was back over here when we had this significant rise in the price of oil. Are they going to do that? Well, we'll wait and see. It seems like not many people think they're actually going to go through with it, with the fact that oil has moved back to the upside, but we are almost back to near the highs, and I've seen some pretty high forecasts on the price of oil. I think the consensus is around $90 a barrel, but I've seen some as high as 120. Certainly don't want to see that occur, and I don't know that OPEC is going to let that happen. So I think those are some extreme levels. But could we break above this level and go higher? If they don't add to their production, then we certainly could move higher with oil from there. But pretty nice move. We actually had an alert on oil for our alert subscribers with Elliott Wave options that we closed out this week just because of the fact that we're getting back into this area of resistance. So let's kind of see how oil handles or USO handles this 58 level. Bitcoin. Well, we talked about this a number of times. Bitcoin needed to hold 44,000, and it had for a while. but not anymore. We've broken below that, and we're trading around 41,000 and change at the time of this recording, and we're in dangerous territory here as far as disqualifying this five-wave impulse pattern to the upside. It wouldn't take much of a move lower from here for that wave forward to disqualify. We get to 70%. That's where Elliott said that the impulse pattern becomes disqualified. And basically what that means is that we're going to retrace that entire impulse wave 3, and that is a target of around 32,000. That could very likely happen. Curious as to what you all think of Bitcoin. Leave a comment in the comments section. Do you think Bitcoin goes down all the way down to 32,000? Do you think it holds and recovers from here? A lot of people think that the Fed's comments has basically blown everybody out of risk assets. And certainly that's where Bitcoin is. Other people feel like, well, this is more to the fact that the current generation is not really excited about with the environmental effects of mining for Bitcoin, and they're looking at other cryptocurrencies, and that's what's causing this move to the downside in Bitcoin. So again, curious as to your comments or your thoughts if you'd leave a comment. Where's a place to go? Well, if interest rates are going up, you think the financials. And that's performing extremely well. You can see quite a bit of a different chart than we have with the SPY. So the XLF, remember, financials do well when interest rates move to the upside. As the spread widens, they make more money because they borrow on the short end, lend on the long end. And so as the spread widens, that gives them an opportunity to make more money. So interest rates going up is a really good thing. And you would expect some sort of a bullish move out of the XLF, but that's been a pretty impressive move so far. Possibly a little bit overbought. Maybe we rest a little bit at the beginning of the week, but again, a sector that you may want to look at for the coming year. And you look at the DMI, and that gives you an idea of the fact that, wow, we could be looking at something far more to the upside on the XLF. We're not quite there yet, though, but look at the setup here in the DMI. The positive directional indicator almost vertically down, the negative directional indicator almost vertically down, the positive directional indicator almost vertically up, the ADX moving to the upside, and the key level there that I watch is 20. We haven't quite broken above 20, but could do that in Monday's trade. So if we get the ADX breaking above 20 with that kind of separation between the two directional indicators, that's telling us that this move is strong and likely to continue, and that could be a pretty tradable move. Taking a look at the VIX, moving to the downside on a down day today. That's pretty interesting. But it wasn't quite the hard selling that we had on Wednesday. But note that as nasty as Wednesday was in the markets, not a massive spike on the VIX. That could set us up for some really serious selling there as well. Others may argue that it just means that the market doesn't really care about it, and because you didn't get a spike in volatility. So there's two sides to the argument there, which is really interesting. So there's that support level at 16, and I've moved it down to 15 if you've watched the last couple of recordings because of the number of times that we touched that 15 level. So we're still elevated on the VIX, but for me personally, I found it pretty interesting that we didn't have more of a spike, something along the lines of here, what occurred back on the 26th of November with the big move that we had to the downside on Wednesday's trade. So that gets you caught up. Hope you enjoy a wonderful weekend, and we'll be back to talk to you again next week. Take care, everybody. If you like these recordings, I'd like to invite you to join our new TradeFinder Live, where each and every week we do a live webinar where we talk about the market, but we also go a little more in depth into the technical analysis system that we utilize to forecast where the market's likely going to go, and also to identify trading opportunities. Get your free subscription today. Take care, everybody.